Okay, so this is the euro dollar, and if you remember about the last video, we talked about the 1.1800 level, which was quite important. And what happened last week is that the price has pretty much leveled down at that level, at 1.18. Breaking it down, coming back up, breaking it down, coming back up, but not breaking it down significantly. Um, Basically went down maybe 50 pip under and is now at 1.1836. The chart that you see is the daily one. You can see that there is the trend dragon trend line up and down. I basically draw a blue line to show those two lines, the one for the support at 1740 about, and the one for the top, which is 121.62. So being a significant level which has not been reached since 2005, you could expect to have two things happen: technical retracement or a breakdown. Though this week we probably will see what's going on. The reason why it's not moving so much is because of the non-farm payroll. Non-farm payroll numbers were good, except that the wage in the United States has actually decreased, and so people are just try to weigh that in. Consequently, they don't expect the Fed to raise interest rate yet, and so if they don't raise the interest rate, obviously that makes the dollar cheaper. Okay, so unlikely in this case that it's not very good for the dollar to go up against the euro if the interest rate are low. Okay, so there's this space that was created, and basically there's two options. Either you can look at a short under the trend dragon line support at 1.1731, and the stop loss would be quite big. Normally following trend dragon you would have to put it at 1.2160, which is about 400 pip. Okay, if you want to be a bit more conservative, you could actually put it in the low, or the previous high right here, which of course would make it a little bit easier, or a bit tighter stop loss on this one. Okay, now the range that on the daily, you could see a retracement all the way up to the trend dragon trend line, or the trend dragon resistance, which is 400 pip. Okay, so that's quite big. Okay, if you decide to go short at the break of that level, you maybe want to look at a lower time frame and base your decision based on that, knowing that possible the price could go back 400 pip. Okay, so that's one possibility. The second one is to basically wait to see if the price is actually going back up, which would be a lot better. If the price would go back up higher and go back to the trend dragon trend line, then that would actually be a really good thing after, if it retraces. So if it goes back up here and then come back down and break that line, then it will be a lot more powerful. In any case, you can trade both. You can trade both scenario, knowing that if you go long, it would be a counter trend trade, and as you know, counter trend is a bit more rockier and a bit more difficult. The best thing, of course, if you want to go long and you're patient, is to wait for a reversal pattern, at least on the daily chart, which right now we don't really have significantly. We would have to see when the price, if the price retraces back to this level here. We would have to see what is the behavior of the price, and maybe it would actually create a base there that would actually be a head and shoulder. If that happens, then pretty much it would say that the price is not going to break 1800 or 1.1800, but will actually resume back up, which is quite possible. If you remember a couple of months ago when the British pound was so high, broke a significant level up, hover at that level for quite some time, actually a couple of weeks, and then after that just went completely broke completely down. We got caught into this one, so let's maybe not do the same mistake. Now, if you're looking at Fibonacci's retracement, the Fibonacci retracement tells us that the price could actually go back up to the 38% area, which would be basically at that level, same about where I draw the square previously. That level will be 1.25 figure about. If it does that, it's actually not a bad thing for the downside, but obviously in this case we will be looking at a retracement of over 700 pip. So for this week, the only play would be to look at a breakdown under 1730, or look at a counter trend going back up. Probably you have room, about 400 pip room on the upside, to potentially even going to 700 pip room on the upside. So we'll go and look at the hourly chart and see what it says. To finish on the daily chart, if we look at that configuration here, this is actually a continuation pattern to the downside. It's called a flag, and actually, to add to it, if we do a Fibonacci retracement, we can also see that if there is a retracement, it's going to be at the 38 or the 50, and the 50% retracement coincide to the trend drag and trend line resistance at 400 pip that we talked about earlier.